Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets, from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Mustafa. It's always great to have you on the podcast show.
Thanks, Bilal. It's a great pleasure for me as well.
Great. Okay, I thought maybe, as we talk about macro, US rates and so on, let's set the scene somewhat. And let's first get your opinion on how would you characterize what we've seen in the movement of, say, the US 10-year bond yield so far this year in 2024?
Well, it's been fluctuating ups and downs. Market having some price discovery. We started the year with very dovish press conference from Chairman Powell, and so and it's supported by a sort of cluster of weak data. So we had demand, and the rates sort of rallied down, and then we get a bunch of cluster of strong data, and then it came back up, and then now we're getting it's going sort of 4.5 to 4, closer to 5, and it's fluctuating in that 50 basis point range. I think it will probably continue to do that. I think markets, I think it began at the end of the Fed hiking cycle in July last year, that markets trying to figure out how to deal with the two-factor world as opposed to 13 years of one-factor world, which was zero rate. Previously, we were zero rate, and only the long end moved. So information came into the yield curve, and we had tens move. Now we have policy expectation of the front end changing as well. So there's a very important factor working on the front end, but also the long end factor.
Okay, so before this hiking cycle, investors just needed to think about the 10-year and just the noise there.
Correct.
Now they have to think about the front end as well, and linking the two as well. They have to think about how the two map to each other.
It is a price discovery process that the market is still figuring out. And that's why we see often some sort of a confusion about how much of the rally is expectation of eases and how much of the rally is just demand from real money accounts and especially demand from pension funds, etc. I think there is a fundamental change that has taken place in the US economy and probably the rest of the world as well, which I sort of summarize that whole change, the big one, as path dependency. And 12, 13 years of zero rate have structurally changed the market, the expectations, economy, etc. So all of the usual responses seems different from what used to be traditional macroeconomics tells us. And so we're going through this process of this effect of path dependency on interest rates. I was just looking at, since the pandemic, the amount of wealth increase among households and other players in the economy, it overwhelms all the small sort of GDP data or inflation here and there. And there was a $47 trillion increase in household wealth since the beginning of the pandemic, the pre-pandemic to today. 12 trillion of housing wealth, housing home equity, 32 trillion of paper financial asset equity for households. So now it's so large relative to GDP or anything else. So this wealth has a bigger effect on consumption or any other decision making. Instead of, oh, let's raise interest rates, so I should consume less, or company is going to cut down on production. Those are tiny, tiny little things compared to this $47 trillion of additional wealth in household balance sheet.
And how does that link to the path dependency that you mentioned? So the path dependency was that everyone got used to zero rates for a long, long period of time. Then the pandemic happened, this wealth increased. But how does that then link back to how does the wealth link back to this path dependency?
There are many ways the path dependency got introduced. One of them is through the liabilities, that because the interest rates had remained so low for so long, key players in the economy, especially the households, but also firms, have been able to lock in a very low interest rate for a long period of time. So that's not changing. So their net liabilities have gone down. So net wealth has gone up. So that's one way of, that's one example of path dependency. The another example of path dependency is the banking system has exponentially increased their balance sheet. Either the excess reserves that that's supposed to be a liquidity tool for the banking system, but banking system just took that and just used that to expand balance sheet even more. And there's a ratchet effect. You can increase balance sheet, but you really cannot decrease balance sheet. So that also a part of this path dependency, that all this reserve growth that has taken place added more to the balance sheet of the banks, to the credit availability, all of that has increased. I can keep going on some of the other path dependencies like housing supply. There's no existing homes or zero supply because no one wants to sell. And so only market is really new home production. And so that's a small part. It's very small relative to household formation and people getting older and needing the house. So this imbalance is growing because, again, of the zero rate policy for a very long period of time. So there are many little path dependencies that has created massive amount of wealth on top of the extreme fiscal policy during 2020, 2021. Even recently, with some of the Biden stimulus also. So these are all adding wealth into the system. And so
I suppose what you're saying there in some ways is that given this backdrop, that this path dependency is there, the wealth effect has increased so much that the Fed raising rates as much as they did, which they claim is very rapid to 5.5, and that's like so fast, that they've misunderstood the effectiveness of Fed hikes. That they thought, like, if we just hike like this, like we do in previous cycles, that would be enough to bring inflation down, slow the economy down. But because of the factors you mentioned, that's not enough because something has changed, and they don't understand the transmission mechanism that well anymore.
Precisely. So this whole talk of, real rates are too high, this is a 90s kind of conversation. And you hear it often, like real rates are too high, and therefore the Fed needs to cut. This is not a 2024 conversation. 2024 conversation is about levels. this level of wealth rather than the changes, which is output, or level of prices as opposed to inflation, because that's how path dependency is reflected in data, is through having more effect on levels than changes. So I think that this whole traditional way of thinking is sort of misguiding some of the Fed thinking and some of the market thinking, and market jumps to buy too quickly. And the Fed, as soon as they get an opportunity, sends a dovish message, and some asymmetric dovish message. Every Powell presser is like a dovish party. Like before and after the presser, you can feel how the market moves. And so it's that's thinking, or this not having a good grasp of the level thinking rather than focusing too much on the change. I'll give you more examples on the rate. Why I'm trying to just get this two-factor part in my head very clear. And the other one, why does the long end persistently stay inverted, or got very inverted right after the Fed stopped hiking in July last year, and then long end then anti-clockwise, or clockwise? No, anti-clockwise. Yeah, anti-clockwise moved back up in October, and then so the one thing I see there is a interesting correlation. One of them is in auctions. Well, the government has to fund because the deficits is going higher and higher, interest rates getting higher and higher, auction size is getting higher and higher, and we're not seeing significant increase in foreign buyers or foreign participation in auction. But then we look for who the buyers have been for the last 18 months. It's mostly the real money accounts.
So this is like US real money, you would say.
US real money, pension, etc. And so their share has gone up from below 45-ish% of auctions to 70-ish% of all auctions these days, of coupon auctions, like higher duration products. Why do they why are they suddenly a buyer when the Chinese are not a buyer, or neither Japanese buying are not significant either, while supply has gone back quite a bit? I think it's connects back to that wealth effect, that households now not only have a lot of wealth, so their overall risk of their household balance sheet is low. Households also have very short duration on their balance sheet, just because they have all this termed out debt. And every other player is like that. Companies also have termed out debt. And most interestingly, pension funds, which usually are exposed to interest rates going lower, because they always have a duration gap between their liability stream, which is usually very long, and their assets. Now, this is a great opportunity for the pension funds to close the gap, also at this higher rate, as the Fed has been raising the short-term rate. So you see that all these players, or BlackRocks of the world and pension fund, the other sort of all the other money managers that actually manage money for the pension funds, just go ahead and bid more and more into the 10-year auctions, 30-year auctions. All of those are taken out quite a bit. So what we get is an inversion. So that piece of data is to me, it's very important and reflects the wealth effect on the market than and just the data just adds some fluctuations. And in my opinion, Fed just adds noise rather than information. And I'll come to that.
Just to be clear there, when you say the real money are buying bonds, is that as a hedge for their short duration position in effect, or is it
mostly hedge?
Okay. And the link with the wealth effect is as the wealth effect picks up, the wealth effect is implicitly a short duration trade.
Not only a short duration, it's also firstly a short duration trade because of all the extensions.
Yeah.
And for pensions, for example, it's just that they have to match their the liability stream is still very, very, very long duration. So it's kind of a short, they're perpetually short. And so, but for households, which is a very large owner of assets, it's basically a short duration balance sheet. But not only the short duration is short, the equity of the household is higher by $47 trillion. So they can't go and they have to add more duration, more risk to their balance sheet to otherwise their risk of their household equity is too low.
Okay.
Yeah. If you get rich, suddenly you get dumped with a bunch of wealth. Your risk would be too low if you are sitting around with your old balance sheet, old risk assets. So you need to go and buy some risk to rebalance, to reflect your higher wealth.
Yeah. But buying bonds, that's a safe investment, isn't it? I mean,
duration is not a safe investment. In fact, if you look at the money market investment, it's only a couple of trillion increase.
Okay, understood. So they are taking duration risk. So it's coupon risk you're talking about. So they're basically risk. Yeah. Okay. So they take some equity risk, whether it's housing, S&P 500. They take some duration risk, which is the like a 30-year bond, sovereign bond. So they're basically just increasing the risk across multiple different asset classes. So hence this demand, constant demand for these bonds, which is keeping the curve more inverted than you would have thought if without knowing that.
Precisely. And only time it disinverts is when they slow down. You see the little bit of a slow, and there is a pattern to this. When there's a little bit of a fear that Fed might ease. In the front end, you see instead of 1 or 2 eases, you got 5 or 7 eases. Then it seems like the long end also rallies, and then the participation of the real money goes higher. And so there's a little bit of a dance between outlook of the Fed and the demand in options. And the another piece of data to support that for me is to see the commitment of traders data. And that seems to fluctuate a little bit with the rates as well, because I don't know which one causes the other, but it actually tells you an interesting story about who the buyers are and how the execution is taking place and where the volatility is coming from in the long end. And it's simple. Real money, like the ones that I managed, for example, when we decided to add duration, we wouldn't just go and buy treasuries. We would get long in the 10-year note contract, most often 10-year note contracts, sometimes other contracts in the futures market. So commitment of traders data will show quickly real money buying increase. But then the other side of that trade, those that are long, those that short the futures contract, will then have to buy something else. And those are the guys, the dealers, that go and buy the treasuries. It used to be just the dealers. Now a lot of the hedge funds just specialize in that. A big chunk of their capital just goes on just equating the real money demand with the treasury market. And so you see this demand is also reflected in how the commitment, there is more relationship between commitment to traders than it used to be with the rate level. And I think it's just that wealth effect, low risk among households, and desire to rebalance by pension funds, all coming into the market. And when the rate goes lower, they buy more. And that's always, it's a classic about this sector. You chase the market, and the rate goes up, you slow down and say, oh, maybe I should wait. And so it's not opportunistic, it's chasing the market. And that's why you see whenever there is a data flow that causes outlook on the Fed eases to be more, or Powell gives a dovish message, then not only the front end moves, there's a bid in the long end, and you see that reflected in commitment of traders as well. So it's not causing anything, but there is a relationship that's established. But at the end of the day, it's just that wealth and balance sheet risk matter more. So for the Fed to ease, it just doesn't make any sense to me. Just forget all these years playing with the bond market or doing econometrics or what. It just doesn't make any sense. So when Powell gives the vibe in a press conference that, yeah, we're almost there, or we might, it just shows that he's not seeing this other big wave. He's just seeing the inflation.
But say on the inflation side, I mean, if he was here, he would argue that, okay, I don't look at CPI, I look at PCE, and core PCE is like below 3%, and it might go to like 2.3 by the end of the year. That's close to mandate. So I can now afford to cut rates, and real rates will be going up if core inflation's falling. So it's prudent to cut rates. You know, he'll kind of raise all of these arguments.
He's doing it all the time. So we see that. But there is a reason why it doesn't go to the 2% or whatever target as easily. And we're seeing, my feeling is that I just focus on the shelter. I'm not I was trained as an econometrician in my youth, but I don't try to do the whole everything about inflation. I just look at shelter and just follow one thing, like how resilient is that, and how will that be and that first, shelter matters for people because people, it's a pocketbook thing. Every month you have to write a check to so it's one of those inflation components that hurts if it goes higher. And I look at shelter, and I don't see, I still see no homes, supply of homes still really low, affordability really low. I see backlog in builders' inventory, the backlog of orders, massive. And the price of the backlogs are much higher than the price that they're signing deals now. So status quo, if it remains like this, I don't see home prices going significantly lower. And so eventually home prices are present value of the supply of shelter over a long period of time. So yeah, we might get a few months of weak data, but in the long run, I'm not seeing there is a significant weakness in the housing market, which would cause supply of shelter available. We saw occasional pockets. Well, recently we saw rental market data. I think I was looking at the Redfin data of rentals, new rentals, and Sunbelt states has gone down. I'm probably slipping. No, yes, true. Sunbelt states going down, and then the non-Sunbelt states like New York and East Coast and this going up. So overall, it's a regional thing, but overall, it's still. I was in Dallas about 3 weeks ago, and the Uber driver told me at last double rentals are going down in Dallas, and he said he thinks it now. Because he's a renter, and yeah, when I checked the data, Redfin showing rentals are going down in Dallas. That's not happening in Washington D.C. or Virginia or any a lot of the other coastal states. So I don't see a significant trending down in rentals. So I think yeah, it will be very slow the last mile.
And
Very
I
slow.
suppose what you're really saying is that in some ways, he shouldn't be focusing on changes of prices or changes of growth of the economy. Rather, it's the level, it's the balance sheet that matters. And so if they really want inflation and all this excess to kind of come down, they have to bring wealth down. Is that a fair characterization of what you're saying?
Yeah, but that's not easy. I was listening to I've been listening to what's his so some commentators in the market was saying that Fed can actually slow down the economy by easing and not not hiking. So they should ease to slow down the economy because a lot of corporations, because of their debt maturity, all the maturity ladder they have, easing might actually reduce their income relative to the debt. So it may succeed reducing inflation by easing. But again, even those commentary are flow-based. Just say you ease 100 basis points and mortgage rate goes down to, let's say, 6% or 5.5%. It's going to set housing market on fire because it's the your people are locked in at 3.5, so they will still be locked in, so no new supply. At the same time, the affordability for new buyers, the young people that want to start a household, it's just become a little better. So then it will not achieve. It's not symmetric, and these are all part of the path dependency, totally misunderstood. So yeah, maybe reducing rate would actually reduce inflation. I think BlackRock was saying that somewhere in the TV. But it's just but again, it doesn't take into account the level part of it. The level which housing market will be set on fire if they reduce a rate by 100 or 200 basis points. And then if it goes back to zero, we don't know. So best is to just economy. Clearly, we are seeing data that shows that this economy can sustain a 5.5 Fed funds rate without blowing up. And since it's nothing bad is happening, if I were Powell, I would just keep the rate at this level. And what happens? And let the new paradigm first recognize the new paradigm, which I don't think Fed decision makers have recognized the new paradigm. That recognize the new paradigm, watch how it plays out, and then decide at the end of this year, early next year, what you want to do in terms of monetary policy. Easing will not make any sense. Hiking might make sense if inflation starts creeping back higher again sometime towards the end of the year. We don't know which direction data will go. We see sort of ups and downs in the data. But I will tell you more problems. That's level kind of problem. I was just looking at the bands in the United States. Like if you look at the loan officer survey, the lending standards are actually getting easier, not tightened. It should be, right? With all these hikes and QT and all of that, the reserves had declined somewhat. The lending standards should be tighter, but it's actually gradually getting easier. Even floating rate loans, like car loans, etc., it's only getting a little bit tighter, not consistent with the tightness we've seen in the past. So we're not having any effect on lending standards of the banks.
And you're referring to this quarterly loan officer survey, which is
quarterly loan
conducted across all the banks in the US and asks, are you tightening standards for people? And what you're saying is it's not tightening. The standards aren't being tightened.
It's not tightening because banks are, if you look at just like households, if you look at the flow of funds data, the bank assets since the beginning of the pandemic has gone up by about $27 trillion. Plus, all kinds of government guarantees. The government has decided that it will not let any bankruptcy. But how do you run a financial system without allowing for any bankruptcies or any liquidation? So you got all the guarantees. You got $26 trillion of additional assets in the matter of 4 years. They still want to lend, even if at 5% and 5+. I myself was wrong in assuming that the duration of liabilities and deposits would be low, but duration of deposit turned out to be pretty high. So they also have a very long duration. Everyone has long duration liabilities, including the banks, longer than I had anticipated. With all the credit guarantees from the Fed programs, credit guarantees from home loan system, banks are ready to ease their lending standards rather than. So a little bit of fluctuations in inflation data or payroll data, any of that doesn't tell me that we're going to a serious recession or serious slowdown in the economy. If I'm to take a risk, I will take the risk on the other side, which is that it could go much stronger with a little bit of additional stimulus.
But I guess, from what you're saying, it sounds like front-end interest rates could remain sort of high-ish, between 4.85% for the balance of this year. But in terms of the long end, coming back to this inversion of the curve,
correct.
Are you saying that because of this constant flow, the curve can stay inverted, or do you think there will come a point where the market will say, "Hang on, we have to bring some term premium into the curve. At some point there has to be some steepening," or is that not what you're saying?
No. There is going to be term premium. There's more volatility in the long end, and the easiest way to see is the convexity premium, which is a little bit of a hump between 10-year and 30-year, is a function of volatility of the long end of the curve. You will see there is a hump that has reappeared after many years. It had disappeared for a long time, and that just reflects that the market is perceiving more volatility in the long end to be here and more to come, and that's one reason for term premium. And then you will see this pension buying or household buying also sensitive to data, just like Fed outlook is sensitive to data. So occasionally you will see a buyer strike and term premium going back higher, as we saw in October last year, and a little bit of a preview of that in until early April for about 4-week period. We had a term premium show up. That's the long end buyer, real money buyer strike. The other way the volatility will be introduced and is introduced already, that there is the intermediaries, real money to futures to fast money to cash. That basis risk creates some additional volatility in the treasuries. That we saw that also in the last 1 year in the long end, and that might actually expand. So all of that will bring some term premium into the system. But just and then the Fed itself is introducing some term premium, because the Fed gives a message that in December it gave a message that we'll almost immediately start easing. Some people were even betting January ease, and there was no need. They just had a couple of data points. That doesn't mean they're supposed to conclude such strong conclusion. And then they changed the story completely to another couple of data points. So that volatility has not only in the front end, but also in the long end.
Okay, yeah, understood. And so from a trading perspective, then, like how would you position yourself in this type of environment? Would you go short rates, like short the 10-year? Would you put a curve trade on? You mentioned this hump in the curve. Is it a 5/30s trade, steepening trade? I mean, how do you sort of, as an investor, how do you position yourself?
Generally, not a long-term view, but more just in and out of short and long position. I think that if we get a cluster of data, as we are now in the middle of cluster of weak data, and so we rallied, we're at 4.4 or something like that, and that's still pretty low. So I would not be long. I'd probably be a little bit biased short for more of this 4.5, maybe 4.75 type of target. But again, we can be shocked by another weak reading. As this weak reading kind of ages a little bit or gets a little bit more stale, then a little bit short. So I'm a little bit short, and then that puts me also a little bit short on risk assets as well. Even like today, I mean, it's very hard to see how to explain the risk asset movement. Just the Magnificent Seven rallying, everything else kind of failed. Nothing to do with interest rates. So there is this.
And then from a big picture perspective, many people are saying that the highs of last year in October, when the US 10-year went above 5 or around 5% or so, that's the long-term high in US yields. Now we've seen the high, and that's it. Now we're just going to head down. I mean, do you agree with that, or do you think it's not? You can't make that.
I don't agree with that at all. For a very long term, not at all. If you think about very long, 2 to 3 years, maybe 4 years, I'm totally on the opposite side, that we haven't seen anywhere near the high, because the structural global factors are all for higher rates, whether it's deglobalization or the persistent increase in borrowing needs by the US government. Everything is pointing to higher rates, plus the fact that households are rock solid in their balance sheet. It's going to be very difficult to cause any damage to their balance sheet by increasing rates or rates remaining here. There is long term, if you take the data noise out, it's going to be higher rate. No, I'm totally off that camp. The 5 is not the highest we've seen.
Yeah. And generally, I mean, you've kind of when you the way you've talked about markets and the economy, it sounds fairly positive. But in terms of more negative scenarios, risk-off scenarios, recession scenarios, how could that come about? I mean, what's the path that could lead us there?
That's the $1 million question, and I spend a lot of time thinking about.
Like, for example, I
The
mean, last year we had the regional bank blowout, so that was everybody thought, okay, this is it, this is the crisis. And it fizzled out very quickly, partly because of the bailouts and partly because, there wasn't the deposit flight that people thought and big banks were safe and so on. That was one thing people got worried about. Then this year people talk about, okay, there could be an oil shock in some external factor, which of course there always could be something like that. But, what do you think?
I think that a large shock has to be something to do with asset prices. A large negative shock has to come from asset prices. I don't know how to describe a bubble versus a non-bubble, because all my life I tried to make a call on a bubble and it bursts, but a lot later than I think. But a lot of tech stocks seems like very inflated to me, especially in the US. And same companies that are making same product, same profitability, it's many times trades at a many times higher price than in the US, than in other countries. So one of them is mispriced. But the question is, will that, given the wealth of the household, will that bubble be just kept going on and on, or at some point burst? So that's the main reason for the bubble, in my opinion, is, as I said before, is government. Government has basically taken a bigger and bigger share of the economy. Whatever is left in the private sector now, then it has bigger claim on everything else. So it's going up in value. And so
And bigger claim insofar as, whether it's the Fed's balance sheet, the guarantees extended to banks, so implicit risk, explicit risk, or the fiscal program. So in multiple different ways, you're saying that the share of government direct or
has
indirect
gone up big time.
Yeah.
Especially in a probabilistic sense. Like, take, for example, Yellen's implicit guarantee to all depositories. In the Congress, when it was asked whether uninsured deposits will be honored, she didn't say no. She didn't say yes. This is really significant because the Secretary of the Treasury of the United States didn't say that uninsured deposits will be guaranteed. That's like think about how much it means for wealth owners and depositors and the whole, whoever is funding the 26 trillion additional balance sheet into the banking system now sleeps really well. Just look at the high yield. High yield OAS. I just checked before we started talking. Twice in our career, it was tighter than this. One was 2007, before the subprime collapsed, and once before the LTCM collapse. It was never tighter than this today. At 5.5% Fed funds rate, people have perceive no risk in the system. And so, something has to, some sort of at these levels of high yield and same in investment grade, every sector you look at, like extremely high valuations. and it's heavily pumped up by the government, in my opinion. But there is a way that even government pumping out could still not protect some of these, like especially this this tech industry that's just multiple times appreciated in the last 1 year. That could, and then there could be a bubble burst in home building. I mean, home builder stocks have doubled, almost same as Nvidia. The same reason, it's a government-induced price increase. And then there's other little ways of cashing into this wealth increase. We saw the Freddie Mac program to create a agency home equity loan lending program that allows mortgage equity extraction for people who has these appreciated homes. And so that could pump more into the system, but it also makes the system more vulnerable because the leverage will go up. So it has to be an asset price. It has to come through asset price. Fed won't be able to Fed won't be able to do this unless they keep raising to Dominic's 8%, which I still remember.
Yeah. And you haven't mentioned the politics or say Trump and Biden. I mean, do you think elections could be a factor that could affect markets in some direction? Not necessarily bubbles bursting, but treasuries as well. I mean, do you think it matters, or is it just we pay too much attention? Yeah.
Last election it did. Historically, it's the only clear relationship has been a gridlock in between Congress and the White House tends to cause the equity risky asset prices to go up. That's the only statistically significant relationship over years that we have seen. But we also saw last Trump election that the dollar went up, equities went up. Everyone was hoping, thinking that it will be the other way around. Big bets on dollar collapsed, but dollar kept rallying and rallying and rallying after Trump became president in his last term. This time around, it feels to me that both whoever wins, the fiscal policy will be king. They will both want to spend as much as they can. So that driver market is generally positive, but more likely that Trump will have more capacity to increase radical increases in fiscal spending.
Yeah.
Or tax cuts. So if you really put a gun to my head and say, who really would be more positive for the market, Trump will probably be more positive for the market.
Yeah.
And so far, the poll seems to be suggesting Trump is ahead.
Yeah. Okay, I mean, we've covered so much ground and we could continue talking for hours. So I just want to round off the conversation. Yeah. You know, I always like to ask this question to my guests. Have you been reading anything good, seeing any good TV shows or films? What recommendations would you have for us?
So one book that I recently read and also tried to connect to it a little bit by action is The Great Game by Peter Hopkirk. It's a word book, very well-known book, but I hadn't read it before. I was inspired to read it when I was traveling in Western China and Xinjiang province and the Karakoram Highway. That friends suggested that I should read this book because it's so much about this area. And so I got that book and just finished reading it. It's about the superpowers of that time, which is 1830s, 40s, to the whole Victorian period, fighting with struggling with each other, playing games, to basically take control of what we call the Central Asia, what used to be all the way up to Turkey and all the way to Afghanistan on this other side. And that was fascinating. The Russian empires sometimes gaining, and then the British then making gains, making also wheeling and dealing, all these young people around gathering intelligence, building maps. So it's inspired me to travel that whole area. Not some places I won't be able to, but we are going back to Kazakhstan and Uzbekistan and Turkey, places like that, to just reconnect with the book, this whole great game. And not only the superpower gaming with each other is so much effect on the people and the place that they play games with, but we don't talk about that when we write history books. And so it's kind of starting to play out again. So we have wars taking place in different places in the world, in one part of the world, and it doubles the food price in another part of the world. So, but we're just talking about the super big powers, and we're not talking about its effect everywhere else. So I really, really like this book. Definitely suggest everyone, but it also is going to drive my travel plans in the next few months.
Okay, that's great. I think I know of the book. I've never read it, so I might just pick it up as well now that you recommend it. And just finally, what's the best way for people to follow your thinking and your work?
I've reconnected with you, so I will post on the Bloomberg chat when it's up and running. And also I tweet on and off, but I will tweet more given
Great.
There's so much drama. And I'm available in WhatsApp and all of the social media. So
great, excellent. So thanks for that, Mustafa. Yeah, thanks again for your insights as usual, and good luck with markets. Good luck with your travels as well. Sounds like you've got quite an adventure coming up. And thanks again for coming on the podcast.
Great, Bilal. Thanks.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or if you listen to podcasts, leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.